Anthony Grasso here, bringing you financial news that you can use. In this particular video, I'm going to do a stock review on Affirm Holdings. In a recession, is this cyclically challenged fintech company worth investing in right now as a turnaround play? Well, let's find out together. I'm going to go over a summary of the company, its product offering, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell for like your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So as always, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. So Affirm Holdings operates a platform for digital and mobile first commerce in the United States and Canada. Now, the company's platform includes point of sale payment solutions for consumers, merchant e-commerce solutions, and consumer focused application. Now, its payment network in partnership with an originating bank enables customers to pay for a purchase over time with terms ranging from 1 to 48 months. As of June 30, 2021, the company had approximately 29,000 merchants integrated on its platform, covering small businesses, large enterprises, direct-to-consumer brands, brick-and-mortar stores, and companies. Its merchants represent a range of industries, including sporting goods, outdoors, furniture, homewares, travel, apparel, accessories, consumer electronics, and jewelry. The company was founded in 2012 and is headquartered in San Francisco, California. So let's look at some of the news of the company right now. So BigCommerce, a leading open SaaS e-commerce platform for fast-growing established B2C and B2B brands, announced an expanded multi-year partnership with Affirm, for its payment network that empowers consumers and helps merchants drive growth. With Affirm as BigCommerce preferred pay over time solution partner, BigCommerce merchants of all sizes will now be able to use Affirm's adaptive checkout product and provide eligible customers with a flexibility and control to choose which payment schedule works best for them. Now, BigCommerce merchants who elect to offer Affirm to their customers do not have to worry about collecting future payments from customers who check out with Affirm. They will receive a full purchase amount, less fees upfront within 1 to 3 business days of a purchase, and Affirm will handle the payment collection. Yes, this is good news for Affirm, but I do have thoughts regarding the viability of the buy now, pay later services in a recessionary time. And other news, the CEO of Affirm recently said that the market is wrong about Affirm Holdings because it definitely has tanked over the past year. But, the buy now, pay later company he co-founded a decade ago, he said, quote, "It might take a recession just to prove it." Now, my initial comment on that statement, he wants a recession to prove his business model. Let me just get this correct. So a recession with rising interest rates, less consumer demand, less revenues, higher merchant fees, and higher interest rates to consumers you're lending money to, that's completely sound logic, right? Well, I will get into that later on. But for now, let's go ahead and look at some of the fundamentals of the company right now. So the company stock price is currently trading at $36.63 a share. Well, it jumped up to $37.37 a share with a market capitalization of around $10.4 billion. Now, there's a lot of short interest right now regarding Affirm. So that's building up to about, 39 million shares outstanding being shorted right now. That's a lot. Now, let's look at the revenues. Now, the company is projected to have about $1.3 billion of revenue for its fiscal year 2022, with negative $694 million in earnings. Now, the revenues are projected to increase over the next few years to around $2.9 billion by the end of 2025, but still have negative $645 million of earnings. Now, on the positive side, revenue grew by 63% over the past year, and it is forecasted to grow about 29% per year. Now, let's look at some key measures of the company right now in particular. Now, if we look at the valuation analysis, the most appropriate valuation measure for Affirm is the price to sales ratio. Now, the price to book ratio is excluded since it most likely underestimates the company's book value by overlooking hidden assets such as intellectual property, while the price to earnings and the price to earnings growth ratios are not meaningful because they don't have any. Therefore, Affirm seems highly valued with the price to sales ratio of 9.9 times, one of the highest in the IT services industry. Now, the peer average is only 2.9 times. Now, when looking at the price to sales ratio versus the fair ratio, which takes into account the company's forecasted earnings growth, profit margins, and other risk factors, Affirm seems like a good value based on its price to sales ratio of 9.2 times compared to the estimated fair price to sales ratio of 10.3 times. Now, looking at the profitability of the company, right now, it has poor profitability in comparison to the industry's peers. While their operating profit margin is below the industry median, their net profit margin is negative 50%, and it's among the lowest in the industry. Now, they don't pay any dividends like most of their peers. And now let's look at the growth rates analysis for this company. Now, they saw earnings decline in spite of positive revenue growth during the past 12 months. Additionally, the average company in the IT services industry was able to improve its earnings result over the same period. Now, Affirm is forecasted to be unprofitable over the next 3 years. Even though they are projected to have high growth of revenue of 29.7% per year, its earnings are projected to stay negative and not get any better over the next few years. And finally, let's look at the financial strength analysis. Now, its debt to total capital ratio is 61%. It's in line with the IT services industry's norm despite its increase over last year. Now, the company may have difficulty in making interest payments on its debt. Its interest coverage ratio of 13.67 times is among the highest in the industry, but shows that earnings from day-to-day activities are too small to service the debt. That's an issue. Now, the short-term assets of $2.9 billion they have do exceed their short-term liabilities of $100 million, but they don't even cover the long-term liabilities of $4.4 billion. Now, they do have a stable cash runway. It has sufficient cash runway for more than 3 years based on its current free cash flow model. And shareholders, though, have been significantly diluted in the past year, with total shares outstanding growing by 8%. So now let's go look at what the analysts specifically say regarding this company. Well, the average price target over the next 12 months is only $36.26 a share, with a high estimate of 80 and a low estimate of 15. Now, there's a hold and a buy recommendation, 40% saying buy, 40% saying hold. Now, let's look at some of the actual analyst reports that I could find. So the Street Quant Ratings has a sell recommendation on Affirm Holdings. This is driven by several weaknesses which they believe should have a greater impact than any of the strengths. This could make it more difficult for investors to even achieve positive results compared to most of the stocks they cover. Now, the company's weaknesses can be seen in multiple of areas, generally high debt management risk and generally disappointing historical performance in the stock itself. And also the Forward Equity Research Report, they have a hold recommendation on Affirm Holdings. As a result of their systematic analysis on the three basic characteristics they look at, the earning strength, relative valuation, and recent stock price movements. Now, because the company lacks sufficient analyst estimated data, they place greater weight on the historical earnings per share trend as a measure of earnings strength. Based on operating earnings yield, the company is overvalued when compared to all the other companies they cover, and share price changes over the past year indicates that Affirm will perform very poorly over the near term. So let me bring it back over here. So based on all that information, what are my thoughts regarding Affirm, their business model, and the recession we're going into right now? And my buy, hold, or sell recommendation on Affirm? Here are my thoughts. Now, one question I have as an investor to consider buying this beaten down fintech as a turnaround play, but are we even in a turnaround position yet? I don't even think we are. You know, we have a recession going, we have inflation, we have higher interest rates. Now, Affirm was way overpriced at the peak of the buy now, pay later hype last year. The buy now, pay later is still growing in usage. Some analysts estimates that they put the global buy now, pay later revenue could grow an average of 26% per year through the end of the decade. With that kind of hype, no wonder why some investors were blindly piling into this stock like Affirm and others a year ago. So Affirm generates most of its revenue from the merchant fees they charge and the interest payments from customers. Now, lots of businesses have been promoting the buy now, pay later services as a cheaper way for consumers to make big purchases. And that increasing awareness has helped Affirm grow like crazy over the past 2 years. Now, there are some significant red flags with this company that could prevent Affirm from any near-term recovery. Now, first off, the inflation is slowing consumer spending, and the recession could throttle down firms' near-term growth. The company's buy now, pay later services generally target younger and lower income consumers who can't get approved for traditional credit cards, and that core market could get hit hard by this inflation. A bullish view would say, well, those services will help consumers with more flexible payment options. And yes, that might be true, but the target market, I believe, will decelerate their overall spending and limit their discretionary purchases. Now, those consumers that have already used the buy now, pay later services are now struggling to pay off their debt. Rising interest rates will make it more difficult for a firm to fund its own loans while curbing its ability to raise fresh funds. In a higher rate interest environment like we're in right now, the company must consistently borrow money as they are lending it to the consumers that are using the buy now, pay later services. This will in turn cause a firm to charge higher interest rates and raise its merchant fees in the long run. Just looking at the last quarter 10Q filing of the company warned specifically, in order to continue to expand our consumer base, we may originate certain loans with 0 or below market interest rates under certain merchant arrangements that we do not expect to achieve positive revenue. Therefore, a firm is still willing to operate at a loss to fend off competitors in the buy now, pay later market, to say we're going to undercut them so much that we're going to try to put them out of business for us to stay in business. So that's not a good thing. Another challenge for Affirm is Apple's new buy now, pay later platform could eventually dominate the market. Apple's introduced the Apple Pay Later, which is a buy now, pay later extension of its payment ecosystem that lets consumers split their purchases into 4 equal installments. Apple will handle the lending and credit checks through an internal subsidiary and then fund the platform from its own balance sheet. This is something Affirm can't do. Affirm has to go borrow money to lend out to people. Apple has its own balance sheet that's just going to say we have free money to lend. We're not going to get charged interest on that. Now, from its own balance sheet of taking out additional loans like Affirm, and it's all the other buy now, pay later competitors do the same thing like Affirm. I feel the buy now, pay later platform functions a lot better when they're subsidiaries of larger cash-rich companies instead of standalone businesses. I'll sum it up with saying Affirm has a mediocre balance sheet with limited growth potential. I don't think the company will go bankrupt anytime soon, but I don't see any good future as a standalone company. Now, this company might be better off being taken over by a whale. I would recommend either Google or Amazon, but I don't think anytime soon they're going to do it. I would let Affirm keep declining and scoop it up really cheap if I'm going to buy Affirm. I'm going to let them flounder because, they can't make a lot of money, if they're undercutting the market. So based on all of that information, I'm a sell recommendation on Affirm Holdings with only a 12-month price target of $35 a share. I would stay away from Affirm and I would go after better tech companies in the space. So there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell for your daily stock and cryptocurrency reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.